Good morning and welcome back to NWR's Vantage Point Conference. Up next, we have Grant Hackett, the CEO of Generation Life. Before I hand it over to Grant, I remind you it's a relatively brief presentation before we run into a more interactive Q&A. So if you would like to ask a question, please do by the Q&A function at the bottom of your screen. Grant, I'll now hand it over to you.
Fantastic. Thanks very much, Max, and good morning to everyone. And thank you for taking the time to join us today. So like Max said, it's a very sort of short introduction to the business. So kind of, 5 to 7 minutes, just a brief overview of, I guess, each of the core channels or pillars that underpin our business here at Generation Development Group. And then we can sort of jump around to a few questions. So a little bit about us. So Generation Development Group's been around for quite some time, almost 2 decades. One of the interesting things that we have as a listed business is a thing called a pooled development fund license, and this is the only slide that I'll go through today. And what that is means that there's tax-free capital gains, so any share price appreciation that you receive as an investor, there's no CGT that applies to that, and any dividends that you actually receive are tax exempt. Also at the corporate entity, so for GDG itself, our tax rate is 15% instead of the normal company tax rate of 30%. So some big advantages there. There are some restrictions with that license. Such as, doing things like, we can't do an acquisition that's greater than 30% of shareholder capital and, a few other restrictions within that. And we've managed to be able to play within that framework to be able to retain that license. But as we say to investors, it's not necessarily something that will keep forever. Now, just to go through, I guess, the 3 aspects of our business that really underpin what we do. First and foremost is our flagship product, which is our investment bonds. So we are number 1 in the industry around this. It's just been this financial year that we've actually gone from number 2 to number 1 in total market share. We've always been number 1, or not always, but over the last few years, we've been number 1 in total inflows and been taking a lot more than our natural market share. But it's been, I guess, a big milestone for the business to be able to achieve that and actually ascertain that number 1 position in total market share. That's resulted in us getting up to $2.5 billion worth of funds under management. That was at the end of the 31st of March of this financial year. And look, we continue to build momentum in our business at the moment. We've had a pretty solid year considering, all the macroeconomic headwinds that we've all experienced, whether that be inflation, whether that be interest rates, whether that's, just investor confidence going down and people leaving their capital sort of out of markets at the moment and sitting on the sidelines to wait and see what happens. But we're going to have our second biggest year on record. We've just done 3 record years in a row. So we've had a material increase, particularly from FY21 to FY22, where we increased sales by 57%. And our underlying impact growth was obviously very strong on the back of that. So overall, the performance of the business throughout FY23 has been really, really solid. And you can see there by the 3-year CAGR numbers. I've already touched number 1 on market share and total FUM. In terms of, I guess, what market share that we actually take of inflows, you can see that sits close to 50% or 46% on the latest data. And in terms of underlying profit, you can see the 3-year CAGR of 34% there. And, we're feeling pretty confident with what we've been able to achieve this year and the way we're bringing it home in this last quarter with the huge amount of activity that we have from a distribution point of view. Just to give you an idea of that as a business, and this relates to both investment bonds and annuity, we're doing 38 events over the course of May and June of this financial year. So we're really out there making sure we're positioning our product through our financial advice network, where about 92% of our inflows come from. Now, the next product that I'll touch on is annuities. So we were really the first of its kind investment-linked lifetime annuities. So everyone would know Challenger, who have been the dominant player in this space. Their traditional lifetime annuity over the years has been very, very popular. Given the legislative change that we saw in 2017 around innovative income streams, actually meant that there could be a more broader range or broader set of products that could come out to the market. And the reason that we've gone down, I guess, this particular path is because it's such a big opportunity. So there's currently about $800 billion sitting in post-retirement assets. And that's going to double to around 1.5 trillion over the next 6.5 years or to 2030. So that's obviously a material opportunity. Account-based pensions are pretty much the only product that's utilized in that space, besides the small category lifetime annuities is now, which is around 1%. But if you think about that 1.5 trillion and you think about this product category opening up, particularly on the back of that legislative change and the optionality that can be created now, even if this category grows to 5 or even 10%, 20%, with very, very few players, only 5 real competitors in there at the moment. It could be quite a material uplift in farm and sales opportunity for this business. In terms of this product, and I guess what it does is, one, it's investment linked, so you can choose an investment of your choice, which any appreciation within that investment means your income obviously improves over whatever time frame that is. The second part is that we guarantee income. So this is underwritten by or reinsured by Hanover Re, which is #1 in longevity risk in the world, and also has a AA- S&P credit rating. Got the flexibility to be able to change around these products. So you want to go from a balanced fund to a high growth fund to fixed interest to cash. You can do all those things. And so far, since we launched that product a little over a year ago, we've got over $14 million sitting in farm, and we continue to see more traction as we educate advisors, get research ratings, and get ourselves on approved product lists. Now, the last pillar of our business before I throw it back to Max to do some questions is on Lonsec. So we made this investment around September of 2020. The deal or the acquisition was completed there in October of that year. We took 37% at that point in time. Since then, we've done 2 selective buybacks that took us one up to 41%. And now with a selective buyback earlier this year, pardon me, that actually took us up to 49%. So we're thrilled to take more equity in that business. We were able to retain the PDF when we were able to gain more equity through those selective buybacks, because of the performance of this business has been absolutely outstanding. We bought it because we like the reoccurring revenue around the research business. For anyone that's in any sort of investment product, you've got to get research ratings because it gives you access to distribution or onto approved product lists. And obviously that rating can grow over time, which makes the product more attractive. So you can see there, currently rating over 1,700 products. In FY22, they had 157 net growth of research products that they conducted. But the real growth driver, or the opportunity that we saw given the changes post the Royal Commission, was really around Lonsec Investment Solutions, which is their SMA business. When we bought it, it closed 30 June 20 at 659 million. You can see as of the 31st of March 2023, the growth has been much greater than what we even anticipated. And you can see they've closed at 8.2 billion. Now, the lion's share of that has been organic. However, at the start of this financial year, we completed an investment with Implemented Portfolios, where we acquired 100% of that business, which is about $1.85 billion worth of total FUM. So you can see there, the growth of that's been material. The performance of the underlying portfolios has been very, very consistent. And, the relationships that's been developed through the sales team and through the CEO, Michael, right there, has been fantastic and really underpinned the flows within that part of the business. So, yeah, in terms of the 3 pillars of the business, in summary, bonds continues to go well, and we really continue to dominate in that space. Launched a new PDS this year with new product features, so continue to provide more features to the market that they find attractive. Annuities is gaining more traction over time, and Lonsec continues to shoot the lights out in terms of its results. So yeah, we're pretty happy, particularly in this environment, with the way we're traveling at the moment. But as a team and a high performing team, we always want to achieve more. So Max, I might wrap it up there and throw it over to the floor for some questions.
Thanks, Grant. Just a quick reminder to anyone on the call, you can ask a question via the Q&A function at the bottom of your screen. We'll get into it. The expansion into market-linked annuities has materially increased the TAM. Post recent ratings, can you tell us how you're getting on with these, and how are you getting onto APLs, and what this means for the group?
Yeah, so we've been getting on to more approved product lists, obviously with the additional research rating of Lonsec, and it's something that we have to obviously manage the perceived conflicts there, given that we basically own half of that business. So that is a bit of a process for us. We're also rated by SQM, so we continue to do a lot of advisor education. We've had no trouble in getting the product on approved product lists. So, a lot of the dealer groups that we're going to, IFAs and their investment committees, we've continued to be able to get a lot more traction over that. So, there's now several thousand advisors through that APL process that we've been able to get some traction with. And really, that's probably 30% of the sales process. Now, the next part is working with the various dealer groups to go, well, is there an opportunity at your professional development day for us to be able to get up there and actually present the product? Where does it fit within the portfolio for a lot of your clients going into retirement? How does it uplift, the age pension given, someone's financial assets outside of their principal place of residence? So, we're grinding away and doing a lot of that work. And like I said, just 38 events over these couple of months. We're really out there pushing and educating around this product. And look, we've received really good feedback. I can honestly say that. But when you are growing a new market, there is a lot of grinding around that. There is a lot of hard work, and you can't underestimate that. And there's, a solid 3 to 4 years of doing all the things that I just spoke about for the product to really gain traction. And then you should get that hockey stick in terms of sales growth.
Thanks. Just changing gears to Lonsec. How do you think about unlocking value in Lonsec?
Well, I guess for us, we really focused on the 3-year accelerated growth plan that we put in place. So we got a new chair within that business, a new CEO, and Michael Wright. They've both done a fantastic job in terms of stepping up that business, creating a material step change there. And we've seen that in the financial profile of the business. When we first bought it, its EBITDA for, I'm pretty sure this is right, I'm just pulling the figures from top of mind, but it was about 7.2 million EBITDA for FY20. You fast forward to the first half of this financial year, and it's done 8.5 in EBITDA. In terms of, I guess, we're kind of just past the midpoint of that accelerated 3-year accelerated growth plan that we've been executing on. What would happen in 18 to 24 months time? I guess there's 3 aspects to it. One is, you could get an attractive opportunity to sell a business. The other one is we could, just keep the status quo and start to take a dividend and help support the future growth of that business and not change anything. And then the third aspect to it would be, well, could we buy out the other shareholders that sit within the business? Because we love the business, love what they're achieving, can see a huge runway ahead of it, particularly in Lonsec Investment Solutions. But at the same time, if we were to do that, it means we would breach the terms of our PDF license. So we'd have to make sure that the value in that, the future value in that was quite material for us to go down that path. So I guess, once we get through this accelerated growth plan, they're kind of the 3 options to be able to unlock a little bit more value in that business.
Thanks, Grant. Early in the year, we saw a lot of press and coverage on the proposed super changes. What does this mean for your company?
This is probably the biggest opportunity that we've ever had at investment bonds. There are the material changes that we saw from the coalition government back in 2017. It was actually the reason a lot of the executives came into this organisation, where they capped super at the 1.6 million at that particular point in time. It's indexed, so it's sitting at 1.7, about to go to 1.9. Obviously, the concessional, non-concessional caps were the other aspects to that made this product structure or after-tax paying structure so attractive. But in terms of what's happened recently, and just to give everyone on the call a bit of insight into that, of course, they're going to be doing double taxation for balances over 3 million inside superannuation. If the legislation gets passed, that will kick in and come into place on the 1st of July in 2025. What does that tax actually look like? Well, that additional 15% tax will be taxed on both realised and unrealised gains. And also that $3 million threshold is not going to be indexed. So if you're really looking at what that opportunity is, it's about $208 billion worth of the current super system of balances that sit over $3 million for individuals. So that money is either going to come out, or the other opportunity around that is money, people doing excess contributions inside their superannuation, thinking, wait a second, super rules are always changing. I'm probably going to hit that threshold at some point. I need to look for an alternative structure. A lot of people would be thinking of trusts, they'd be thinking of bucket companies, but really, and we're doing a lot of projects, a lot of marketing work around this, a lot of education. We've already been doing webinars on these changes. And they've been forming part of the events that we've been doing more recently. But it's like that flow of money, where is it going to go? Well, if it goes into a trust, people do that for obviously asset protection and income splitting. Goes into a bucket company, sort of kicking it's a deferred tax liability then on any growth that you're having in the underlying assets in there. And if you want to take it out, put it back in your own personal name, you've got to pay the top-up tax. Where when it comes to an investment bond, we're a structure that has a max tax rate of 30%, but our effective rates for our tax optimized series sit between 12 and 15%. So we've got a significant tax arbitrage in there. You can set it up to be creditor protected, so you get the asset protection like you do a trust. After 10 years, you can take it out. It doesn't matter how much money's in there, how many beneficiaries, that there are of that particular bond or how many bonds you have, and there is no tax to declare. And you've also got the flexibility to be able to change ownership of the bond at any point in time. So we're getting the benefits of the other structure, but we're also getting a lot more benefits from a tax arbitrage and a flexibility point of view inside the investment bond. And also for estate planning purposes, it's 100% binding nominations in there. So if you want to leave something outside the family, or you've got a high conflict family, blended family, want estate equalization, this is the, one of the best structures to utilize. I would say even the best in many respects, depending on what you're trying to achieve. So yeah, that superannuation change and that tax for amounts above $3 million is a significant opportunity for us, just because of the fund size that's already sitting there and how that's going to continue to grow over the next couple of years when this is actually implemented, and how that takes effect also at the end of that first financial year, when people go, I'm paying tax on unrealized gains. Have I got the cash flow to be able to do that? And you're talking big balances here and probably big growth in those underlying assets. So I know that was a long-winded answer, Max, but that is a critical change that we've got to make sure that we fully capitalize on.
No, very good. Once you have customers join the platform, how sticky are they? What sort of change do you experience, and how has that evolved over time?
Yeah, so traditionally we've had really, really sticky funds. So most people come on to the platform to be invested over 10 years because you get tax concessions and there are tax benefits inside 10 years. Also, you get all the estate planning benefits inside 10 years. So if you're passing one of these on and you've only had it for 3 years through estate planning, it's 100% tax-free on death, even if you're a dependent or a non-dependent. It doesn't matter, even just a legal entity. You can leave it to a charity if you want. So in terms of the maturity profile, normally it's well over the 10-year mark, because the maximum tax benefits are post 10 years, and traditionally we've seen that around the sort of 16 or 17-year mark. Redemptions have gone up a little bit this year, but not because people don't like the structure or they don't like the tax benefits. The reason that's been the case, there's actually been quite a few deaths, more than what we've experienced over recent years, and the quantum, the amount of that has actually been quite material for some of those deaths. And we've seen people taking even partial redemptions just for short-term liquidity needs. We always get the feedback on why people are redeeming funds outside of our structure. So that's been a little bit of I think a short-term structural change, just because of the macroeconomic environment that we're experiencing at the moment. But I think, the maturity profile on average is certainly well beyond that 10-year mark.
Thanks, Grant. There's just a few questions here on current market conditions and how that's affecting performance and inflows, and then just a few questions on industry tailwinds and consolidation. So just maybe summarise that.
Yeah, sure. In terms of what's going on, I guess in the current market conditions, you've seen the platform results. For those of you who follow your Netwealths, your Hubs, your Premiums, etc. We've been trending pretty consistently with that through the year in terms of flows. I have to say that the momentum in terms of what we've been able to do in the second half of this year has certainly picked up, and we've been able to capitalize on a few things. So that's been quite positive. So hopefully, we're able to produce some good results over the course of Q4 at FY23. So I feel like, even the environment that we're in, we're not out there trying to make excuses as a team. We're trying to find ways to communicate more to our financial advisors, to their underlying clients, to do more events, to be able to get our active advisor number up, which our active advisor number is a sort of forward indicator for us. That's how many people have written one or more bonds on more products on a 12-month rolling average with us. So we're certainly out there in the marketplace with our distribution and sales and marketing activity very, very proactively. We don't go to sleep and make an excuse just because conditions are tough. So I feel like there's pretty solid momentum in the business at the moment. In terms of some of those structural changes at the moment, we just spoke about superannuation. We're looking at a bit of an increase in the marketing budget for next year to be able to capitalize this. Nothing crazy. So when you're doing your valuations on your spreadsheets, you don't have to go too mad on that, because we're very sort of tight on our expenses. I've got my CFO right here. He's probably grimacing when I talk about increasing marketing expenses. But this is a once in a lifetime opportunity for the investment bond space, and we want to make sure that we're out there educating people that don't use investment bonds or haven't thought of it as an alternative or complementary to superannuation. And obviously, there's going to be people out there that aren't necessarily up to that $3 million threshold, but we want to be able to capture their excess contributions. Now they might just be putting the concessional contributions inside super instead of that surplus amount above that and their non-concessional contributions. So for us, we want to continue to capitalize on that. The other aspect that's, I guess, significant structural change that we're seeing more broadly at the moment is the fact that estate planning is just so big. So over the next 30 years, we're going to see $4.4 trillion transition. It's at a rate of well over $220 billion per year over that time frame. And given just how good the investment bond structure is to be able to transfer wealth, have control, have certainty around transferring that wealth, that's another aspect that we're trying to capitalize. So we don't want to overcomplicate the business and go out there with 50 different messages, but certainly the super changes, the estate planning aspect, are two aspects in these market conditions that we're going to experience for a long time, or structural changes. To be able to capitalize on all of that is something that we want to do.
Thanks, Grant. That concludes the Q&A. I'll just hand it back to you for closing remarks.
No worries. Thanks very much, Max. Look, again, thank you very much for everybody's time today. Like I said, I feel like within Generation Development Group at the moment, we've got good momentum. We've got a good solid team. We've got lots of innovations with our products coming out. Like I said, we just did a new PDS for our investment bond business. We've got a new PDS coming out for our investment-linked lifetime annuity called Life Income coming out this month. So again, that's based on advisor feedback and some of the things that they want to see more of, or some of the features that we currently have enhanced even more. It also means that we're going to have more investment options around that particular product. And when it comes to Lonsec, we're just going to stay very, very focused on executing that 3-year accelerated growth plan and hopefully keep bringing that great performance to market. Thanks to all our supporters out there. We always appreciate it. And if anyone's got any questions, they can reach out to Terence, our CFO, or myself. Thanks very much, Max, and to the whole NWR team as well.
Thanks, Grant. This concludes this session.